Okay, so now what we're going to do is look at the next step, which is the adjusted trial balance. The greatest thing about this is it's exactly like the regular trial balance, except you just do it after you've done all these adjusting entries. So before, what you were doing is you were doing all your journal entries, then you were balancing your T accounts, then you were doing your trial balance. So you've already balanced your T accounts. Now you've done all these adjusting entries on an adjusting entry journal. You have to move all those adjustments to the T accounts. Then you have to balance the T accounts again. And then you just do another trial balance, but this time it's called an adjusted trial balance because it's done after the adjustments, okay? So you do this one exactly the same way as you did before with the assets, the liabilities, the stockholders' equity, the revenues, and the expenses, okay? And you list the debit and credit columns, and then the debit and credit columns need to match each other, okay? So it's no different than you did in the trial balance before. You're just doing it after you do the adjusting entries. Okay? All right, now, totally forget everything we just talked about. I mean, don't really forget it. Don't really forget it. But we're just going to learn something totally different now. Okay. So the adjusted trial balance, you do the financial statements. Let me just mention that. We're not going to talk about these quality of earnings and stuff right now. Okay, we're going to go to a totally new concept now. Totally new. So when you are reading an accounting job, you will often hear or read in the job where it'll say closing the books. Closing the books. You know, responsibilities include closing the books. There's two types of closing the books. There's the month-end close, which is what you just did with adjusting entries. Adjusting entries is part of the month-end close, okay? And then there is a year-end close, and the year-end close is completely different than the month-end close. So now we're going to learn the year-end close, and we're going to talk a little bit about it and why we do this, okay? There's some new rules, of course, right? Of course there's new rules. All right, so you have to know this. You have to know this in order to be able to do this successfully. We know there's assets, we know there's liabilities, we know there's expenses, we know there's revenues, we know all this, right? Well, now we're going to put one more layer onto it. Because some of these accounts are temporary, and some of these accounts are permanent. And we don't mean that the accounts go away. What we mean is that they're, the transactions within them and the balance they hold are either temporary or permanent. So you need to know this in order to know how to close the books.
You mean like they're wiped clean or something?
They're wiped clean. They're taken back to zero at the beginning of the year. So the temporary accounts are the revenue accounts, the expense accounts, and the dividend accounts. And I'm going to tell you why you do not want these numbers just to go on forever. Because if you don't zero them out at the beginning of the year, they get to the point where they have no meaning. They just don't mean anything anymore. And I'll give you an example. Remember when I said that my first really big accounting job, I went to work for a company and I had to transfer all the accounting information that had been manual for 72 years to a computerized accounting system. So when I did that, I had those great big, huge books that had all of the information and all those ledger cards of all the information that had happened over the last 72 years. So let's pretend that they paid $5,000 a month in salaries, okay? So at the end of the first month, if you looked at their income statement and they had $10,000 in revenues and $5,000 in expenses, and the only expense they have is $5,000, that would have meant that they made $5,000, right? Their net income was $5,000. So at the end of the year, 5,000 times 12 is what? 6. What is that? Times 12. I don't do math in my head. $60,000. So at the end of the year, their expense, salaries and wage expense would show $60,000. So if they made $70,000 for the year in revenues and their expenses were $60,000, then their net income was $10,000, right? If you never cleared out that expense account, you would start the new year with that $60,000 in there. So you wouldn't be able to paint a really clear picture of the performance of the organization for that year, right? Or for those periods. The other thing that happens is that the number begins to make no sense. It just doesn't make sense. So if they did $5,000 a month, 12 months a year, for 72 years, at one point, their salaries and wage expense would show $4,320,000. Would it tell you something? Sure, it would tell you over 72 years they paid $4,320,000 in expenses, but it wouldn't really help you much as far as like planning or making any estimates or doing anything within the real now, right? You have to sit down and figure out, well, I really only care what happened in the last year. I don't care what happened in the last 72 years. So what happens is when you do the financial statements at the end of the year, you have a picture of what your salaries and wages expense was for that year. If you want to know what it was for that year, you go back and you look at that picture, or you look at the balance on the end date of that year before it was zeroed out. Same thing is true for revenues. If you earn $100 a month for 12 months, you earn $1,200 that year. But if you continue to add year to year to year to year, after a while, the number doesn't mean anything anymore, okay? So these accounts are zeroed out at the beginning of the year. And we're going to show you the process for zeroing these accounts out. Now, permanent accounts. There's 3 permanent account types that you never zero out, ever. And there's very logical reasoning behind this that should make it really easy to remember these. Assets, liabilities, and stockholders' equity. Assets. You have a cash account, right? And that's an asset, right? How would it feel if you went to bed on New Year's Eve and you had $10,000 in your account, and on January 1st, it was zeroed out, and you had no money? What? Yeah. You'd be like, what? No. Assets don't go away. You don't zero out your assets. Because remember, this is a balance sheet account. It's not like you have, like in salaries and wages. If you have $10,000 in salaries and wages expense, it's not going down. It's $10,000, and as long as everything's correct, that number's just going to continue to go up, right? But with your cash account, what happens? It'd be great if it continued to go up and never went down, but that doesn't generally happen, right? It might go up a little, down a lot, up a little more, down, up and down, up and down, up and down. So that's the number that is just the snapshot in time, right? So your assets never go away. Liabilities. How would it be if you went to bed on New Year's Eve and you had a $5,000 car loan and you woke up on January 1st and you didn't owe that money anymore? That'd be totally awesome, right? For you, but not for the car company, right? That you owe the money to. So liabilities don't go away either. That's another account that goes up and down, up and down, up and down, depending on what's happening. So you do not zero out liabilities. Stockholders' equity. Do you think your stockholders would be happy? Or would you be happy if you had 100 shares of Apple stock on New Year's Eve and on January 1, they said, oh, sorry, we zeroed your account out. You don't have anything left. No, not good. So these 3 accounts will never be a part of your closing entries, ever. You do not touch these accounts for closing entries. You will touch your revenues, your expenses, and your dividends. And you're not just going to go in there and go, okay, revenues are now a 0. Yep. Of course, you have to have a process, right? It's got to be a process that you got to run through. So that's what we're going to learn is the process. Okay, so the process that you do this through is through an account called income summary. This is an actual account title called income summary, and there's a very, very important thing about income summary. 2 important things. Number 1, income summary starts and ends at 0. This account will never hold a balance when you're done with your closing entries. It will start at 0, you'll do your closing entries, it will end at 0. And number 2, this is the only time you will use this account. It's the only time it's used. When you close your books at the end of the year, you use this income summary account, and it is the summary of your income. All your expenses run through there, and all your revenues run through there. And what's the difference of expenses or revenues minus expenses? Net income, right? So what happens is you run your expenses through there, you run your revenues through there, and then the difference is your net income. And what you do is you take that amount that's left in income summary and you move it to retained earnings. And then income summary becomes 0 and you carried over your retained earnings amount. And then dividends does not run through income summary, it goes directly to retained earnings. So we're going to go through the whole process of how we do all of these, right? Okay, so they are done in this order. You need to do them in this order. Number 1, you're going to close out your revenues. Number 2, you're going to close out your expenses. 1, revenues. 2, expenses. 3, you're going to close out the difference, or what you've retained. Okay, that's the difference between the revenue and expenses. And then 4, you're going to do your retained earnings. And this relates back to chapter 3 and knowing what the debit and credit balances are. Because if you have an account that has a debit balance of $100, how do you get rid of that $100? It has a debit balance of $100, how do you get rid of it? You credit it $100. So what you're going to have to do to zero out the accounts is you're going to have to do the opposite of what their normal balance is. So again, we're back to chapter 3, having to know what kind of an account it is, what kind of balance it normally has, and that tells you how you get rid of it. So revenues. Revenues normally have a credit balance, right? So to get rid of the revenue, we're going to debit it. We're going to debit the revenue account for the amount that's in the revenue account. And then the second part, we're going to credit income summary. So on the side, if we're looking at a T account of income summary, hold on a second, I'm just going to put the video on here. So on the side, if we're looking at a T account of income summary, this is kind of how it will look. If this is the income summary account. So after we do that first entry, we're going to credit income summary $10,600. Do you see that here? Income summary credit $10,600. The next thing we're going to do is we're going to get rid of our expenses. Expenses have what kind of a balance? Debit or credit? Debit. So how do we get rid of a debit balance? Credit it. So what we're going to do is we're going to put the title income summary because we're going to do the opposite to that, right? If we credit all these expenses, we have to debit income summary. But we don't know what that total is yet because we have to figure out all the expenses and total it up. So what I would say to do is to type income summary in the box, leave the box blank for just 1 second, then go through and list all of your expenses. And you're going to credit every single one of your expenses to get rid of the expenses. Then you're going to take the total of all of those and you're going to debit income summary. So now, if you look at your income summary T account, you're going to do a debit for $77.40, right? So that's step 2. We've gotten rid of the revenues, we've gotten rid of the expenses. Now we need to recognize how much we've retained, how much we actually have earned after all these things happen for the year, what we're retaining. So what you've retained is the difference from what came in and what went out. So you just do the math here, and it's what, $28.60, right? So we have a credit balance now of $28.60 in income summary. How do we get rid of a credit balance?
Debit.
You debit it, right? So we're going to debit income summary $28.60, and retained earnings has what kind of balance?
Credit.
A credit balance. So to make it go up, we have to credit it, right? So we're going to debit income summary $28.60, and then we're going to credit retained earnings $28.60. So at the end of 12 months, that's how much we've retained of all the ins and outs that have happened over the year. We've retained $28.60. So that's on December 31. So on January 1, what's our beginning retained earnings number? $28.60, unless we had previous year's retained earnings. Okay? So on the retained earnings statements, if we've never had retained earnings before, on January 1, that would be our starting retained earnings number. Okay? All right, so that's step 3. So step 3, we would come over here and we would debit $28.60. Income summary starts at 0, ends at 0. After you've done the adjusting entries, or the closing entries, you're gonna end up at 0. So I recommend you run a T account on scratch paper to make sure that you double check your entries. Just to double check your entries. And you can do it after you do all the entries, before you push submit, just to make sure, okay? And once you do this a little bit, you'll just do it in your head. You'll go, oh, okay, 10,060 minus 7740, that's the difference, that's what I earned. That goes to retained earnings, okay? All right, so it's 1, 2, 3. 4 are dividends. Dividends just run straight through retained earnings. So dividends have a debit balance, so to get rid of them, we have to credit them. So we're going to debit retained earnings. It's going to make our retained earnings go down. And we're going to credit dividends. Okay? So those are the 4 entries you need to do for closing entries. This next slide, this is helpful for some people. Some people say it confuses them, but I'll show it to you anyways. This shows the different T accounts, which is kind of how they end up going through the process and what the balances end up being. All right, so let me stop that there, and then we are going to